Very good morning, friends. So I hope you're all doing good. And as I always keep saying, that I hope you've done your cumulative revision. Though we have covered only one session on consolidation, we started a journey on Ind AS 103, that is on business combination. And as I've always promised, my constructive obligation to give you a quick mind mapping on what we covered in the previous one. So I had given you a couple of things, and today, of course, we're going to formally, deep dive in terms of what we call acquisition accounting. But I think first we're going to just take a little quick recap. If you've made the revisions, you'll appreciate the inputs very well. And if not, maybe still you'll appreciate. But I think it's always better if you keep looking into cumulative revisions each time. So the expectations are on that since the first class is done, you've revised that. Once I do the today's session, you revise both the sessions together, and that will keep giving you a good grip on these standards. Because as you know, financial instruments and consolidation standards, the plethora of standards in consolidation, of course, are very important. Invariably, you do get questions in the exams. You cannot think of a paper generally without financial instruments, without consolidation. They're the core pillars in terms of the paper as well as in terms of Ind AS. So let me, I think, start with the quick mind map in terms of the learnings which we learned in the previous session. So I'm just making some quick mind maps in terms of the inputs I had shared with you. Now, just to recall the concept, I had given you, first of all, the inputs regarding a three-step model. How do you decide under which standard are you covered? So we did basically a very simple three-step model which gave us the input whether we are covered under which standard. So just to give you some basic inputs without getting into details, I had given you, first of all, in step number 1, the focus is in terms of what we acquired. So our focus in terms of step number 1 was what we acquired. So we decided in terms of this, what we acquired, that is the focus point. And when you consider what we acquired, it's either an individual asset, it is either an individual asset, or it could be a group of assets, and that could be with or without liabilities, but we write it as group of assets, but it can be with or without liabilities as well. Now, since we've already covered the special issues also along, I'll just, insert those special issues within the mind map itself. Now, at this stage later, I also made a distinction, and I think you need to be clear on the distinction, that what is the difference? We should also be clear in terms of what is the difference in accounting. What is the difference in terms of accounting when you say you acquired an individual asset or you acquired, let's say, a group of assets which is not a business? So my focus is we need to be clear in terms of what is the difference in accounting. What is the difference in terms of accounting when you say, or rather I would put it in 3 parts. Let's, I think, do one thing. Let's, I think, put this in 3 parts. What is the difference? Let's put it like this, that what is the difference in terms of 3 kinds of accounting? So one accounting which we said, so we're looking at one accounting where we said you acquire an individual asset or you acquire a group of asset which is not a business, or you acquired a group of asset which is a business. So, 3 kinds of accounting came into account. You acquire an individual asset, 1. You acquire a group of asset, but it's not a business. And you acquire a group of asset, which is a business. Now, when you acquire an individual asset, of course, in this case, we would be applying either Ind AS 16 or Ind AS 40 or Ind AS 38, depending it is tangible or it is intangible in nature. When you say it is a group of asset which is not a business, then we need to split the consideration. We need to split the purchase consideration in the ratio of, we need to split it in the ratio of relative fair value. I also explained you the concept of what is a relative fair value. So we split the consideration, the total consolidated consideration in the ratio of relative fair value, because the life of the assets could be different. And when you consider a relative fair value, you need to incorporate the different lives as well. And then when you say it's a group of asset which is a business, this becomes a case of what is called acquisition accounting. This is called acquisition accounting. Now, looking at the two inputs I'd given you, that when you say it is a case of individual asset, and when you say it is a case of acquisition accounting, I'm not looking at the middle one. So we decided that there are certain principal differences, and I gave you three major principal differences between asset accounting and acquisition accounting. So one of the principal differences was in terms of transaction cost. If it is individual asset, it gets capitalized. If it is a group of asset which is a business, it gets expensed off. That was one key difference in terms of asset and acquisition accounting. TC gets capitalized when you acquire individual asset. TC gets expensed off when it is acquisition accounting. The second is in terms of goodwill. In case of individual asset, goodwill does not arise, but in terms of acquisition accounting, goodwill of course arises. And then we also saw another third area of difference, and that was with reference to the deferred tax. When you acquire an individual asset, no deferred tax arises, but when you apply the concept of acquisition accounting, a deferred tax arises. So in this particular case, you need to be clear on the special issue. What are the three kinds of accounting? Individual asset accounting, the relevant standard, 16, 40, 38, as the case may be. Group of asset means first you split the consideration in the ratio of relative fair value. Then of course, thereafter 16, 40, 38 would apply. But if it is a group of asset which becomes a business, then the concept of 103 triggers, and that is acquisition accounting. Okay, now coming back to the input. So we decided when it is an individual asset, in this case, I've already made a mention, we would apply either Ind AS 16 or 40 or 38, depending it is tangible or intangible in nature. And when you say it is a group of assets, we go to step 2. This was our very first step. And then we went to the second step to decide whether a group of asset is a business or not, which I've slightly already mentioned out here. Now, when you go to the second step, the focus in terms of second step is to decide that if you acquired a group of assets, we now need to take a call and decide that is that a business or not. The focus now is to decide the group of assets which is acquired, is that a business or not? And then we went ahead and understood that there are two types of tests which are conducted. So we decided that when you decide that it is supposed to be a business, then we decided that by virtue of Ind AS 103, there are two kinds of tests which will evaluate whether it's a business or not. So later we went out of the three-step model and we went to the two tests. One is what we call the optional concentration test. And the other one is what we call the three-element test, or what I called as an IPO test. Input, process, and output. So these two tests will decide the fate whether the group of asset is a business or not. And we decided something, that applying the option concentration test is completely a choice. And if you apply this test, then it depends whether you pass the test or you fail the test. In this case, we decided if you pass the test, then it is an asset acquisition. It's not a case of a business, but asset acquisition. But if you fail this particular test, then we need to apply the 3-element test on a mandatory basis. And if you say, no, we are not applying this test, the test is not applied. If the test is not applied, then also we need to apply the 3-element test. So that gets the interaction between the option concentration test as well as the 3-element test which is to be applied. Then we went ahead and also decided something in detail. As far as the option concentration test is concerned, I gave you a 3-step model again. In terms of the concentration test also, I gave you a 3-step model how the option concentration test is applied. And I said the step number 1 is to identify the single asset. You need to identify the single asset, or you can say group of similar assets. You need to identify the single asset or the group of similar assets which is got highest fair value. So you need to identify that single asset or the group of similar assets which is got, you can say, the highest fair value. And then becomes the important journey in terms of step number 2. And in terms of the step number 2, I said you could apply step number 1A, step number 1B, and step number 2C. The third step, the second step, gets subdivided in terms of 3 steps. In the step number 2A, you need to add the purchase consideration plus the PHI and plus the NCI to make it equal to 100%. Because when you add the PC, the PHI and the NCI, you could get 100% of the consideration which is paid for the net assets of the company. Then in terms of the step number 2A, you need to add the liabilities, but this will be excluding the notional liabilities, and the only notional liability is supposed to be a DTL. The only notional liability is supposed to be DTL, so we'll add back all the liabilities excluding the notional liabilities. And then we go to the step number 2C, where you take 2B as the base and you reduce the cash and cash equivalents so that we can get what is paid for the assets other than cash and cash equivalents. And once you get the status in terms of step number 2C, we go to the step number 3 and we consider the value. We consider the value as per step 1 divided by the value as per step number 2C. And we take this percentage. And we take this percentage by taking the value as per the step number 1 divided by the value in step number 2C to evaluate whether it is substantial or not. To evaluate whether it is substantial or not, when you say yes, it is substantial, then it is an asset acquisition. And if you say no, it is not substantial, then you need to apply the IPO test in this case because it is failed. Now, this is what we decided on the concentration test as well, the 3 steps to be applied in the concentration test. And then I took you to the IPO test as well. Here again, I gave you a 3-step model. So we've done, a couple of 3-step models. The overall 3-step model, then the 3-step model on the concentration test, then the 3-step model on the IPO or the 3-element test. Now, in terms of this 3-element test, we decided step number 1, step number 2, and 3. In terms of step number 1, we decided, did we acquire the input and the process? Did we acquire the input as well as the process? If you say yes, we acquired input process, you go to step number 2. Otherwise, it's not a business asset acquisition. And then we decided that is there an output or not? The presence of output is decided with the presence of revenue. If the company is generating revenue, that means there is output. If it is not generating revenue, then there is no output. And then we said the rules are more stringent when there is no output. When there is an output, the rules are not stringent. So we decided that if you say that there is no output, if you say that there is no output, then in that case, there were two blocks. Either you meet the two conditions in block 1 or you meet the one conditions in block 2. I think I'll not come to the blocks or the conditions, you know them. So you need to meet either the two conditions of block 1 or you meet the one condition in the block 2. And if you say yes, the output is there, you need to meet a total of 3 conditions in that case. If the 3-element test is passed, it becomes a business, otherwise not. So this is what we did later, but I just penned this around. And when you say the group of asset is supposed to be a business, when you say the group of asset is a business, if you say a yes, you go to the step number 3. And if you say no, then in this particular case, I've already given you the guidance in step 1. I've already given the guidance earlier in step 1 that you split the consideration in the ratio of relative fair value. So this was our step number 2, focusing on the essentials, whether it is a business or not. Okay, that was on step 2. Then finally, we came to the step number 3. And you know, the special issue which I gave you, the distinction between the accounting treatments already covered, and the second one also covered relative fair value ratios. Finally, we came to the step number 3, deciding that which are the standards applicable. So we said the focus is, did you get a control over the business or not? Now, as far as control is concerned, we are yet to understand the control in detail, but we'll do that in Ind AS 110. For the time being, we decided if you get more than 50% voting power, we say there is a control, but we are yet to see the aspects of control in Ind AS 110, and that would be seen later. For the time being, we are considering it to be a rule-based accounting. Your percentage decides the criteria. And we decided something very interesting in this case. And we said the possibility is that either you get a control, or you get a joint control, or you get a significant influence, or you're simply a passive investor. And there are different standards which are applied. But what is important is to apply all this in a sequence. What is important is to see that everything is done in a sequence. So either it is a control, or it is a joint control, or it is a significant influence, or you're simply a passive investor. And we decided a few standards. Let's make a very interesting comparative chart in terms of what would apply. So we can say that when we look at these combinations, would Ind AS 103 apply in this case? Yes, no, no, and no. So in this particular case, this is the only case where Ind AS 103 applies, and we also decided it's a one-time application of the standard on the date of acquisition. It doesn't apply again and again. 103 applies only once at the time of acquisition date. And then we decided separate financial statements as per Ind AS 27. And we said in this case, yes, 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 and in this case, no. And then we decided the consolidated financial statements, yes, that is as per Ind AS 110. Consolidated financial statements, yes, and that is Ind AS 111. Consolidate financial statements, yes, that is Ind AS 28. Consolidation, no. So only the investment appears in balance sheet. Only the investment appears in the balance sheet, and that is by virtue of financial instruments, that is Ind AS 109. So that gives me a complete picture of the various permutations and combinations as well. So condensed everything in the 15-20 minutes time in terms of all the learnings in the previous session. That makes a good mind map. I think if you made your revisions, you would have connected the dots very well. I think so. Say yes. I think if you made your revisions on the previous session, then you would have connected all the dots very well in terms of the three-step model overall, concentration test three-step model, and the IPO or the three-element test three-step model. What all is the nitty-gritties to be applied? That's wonderful indeed. Okay, that's great. So now we are going to go further. I am now starting with the concept of Ind AS 103, and I'm going to first of all give you an exposure regarding things. Let me, I think, first of all tell you, as we go to progress in the standard, it is definitely going to get technical. So I think you've already seen that as we keep progressing on the standard, it gets technical. So today you're going to see things would be a little more technical as compared to the previous session. And the only, I think, good solution for that is keep making your cumulative revisions. That's important. Okay, now let's begin with the concept of 103. Now, please hear me carefully. I'm going to first of all give you, you can say, a bird's eye view in terms of the different kinds of accounting which is given in the standard. You'll get a basic thought process of how you need to think. So let's consider there is a company A Limited, and let's consider there is a company B Limited, and let's consider we did the evaluation and we said A got a control over the business of B. So let's say we decided that A gets a control over the business of B, then Ind AS 103 would trigger. So the moment you say that A gets a control over the business of B, we can say Ind AS 103 will trigger. So in this particular case, Ind AS 103 will trigger the moment you say, yes, it is a business. That means group of assets is a business and you get a control, 103 would trigger. Now, there are three kinds of accounting which are given in Ind AS 103. I'm just going to give you, first of all, a very basic exposure on the three kinds of accounting. So if somebody were to tell me that what are the types of accounting, if somebody were to ask me that what are the types of accounting which are applicable in terms of 103, I would say there are three cases of accounting. I would say there are three cases of accounting. One is called acquisition accounting. One is called acquisition accounting. The other one is called a reverse acquisition accounting. The other one is called a reverse acquisition accounting. So one is acquisition accounting. The other one is called a reverse acquisition accounting. And the third one is called a common control transaction. So there are three kinds of accountings which are given in this standard. One is acquisition accounting, one is reverse acquisition, and one is a common control transaction. Now, we need to be very careful which accounting applies in which case. So let's make one thing very simple to you. You know, if somebody tells me that one does these accountings apply, I would say this accounting applies generally when it is unrelated party. I said generally. I did not say always. I said generally, reverse acquisition accounting applies when the acquisition is between unrelated party. And common control generally arises when there is a related party transaction. Though, of course, a related party transactions may not fulfill the case of a common control, in which case it might be acquisition or a reverse acquisition accounting. But generally, when you approach a question, your basic thought process has to be, is the acquisition between related parties? Then it could be a common control transaction. But if it is between unrelated parties, the chances are that it is acquisition or a reverse acquisition accounting. So that makes one layer of thoughts. Next, Now, how do you distinguish between the fact that it's an acquisition or a reverse acquisition accounting? That flavor I'll give you very shortly, because there are certain parameters which will decide that. So the parameters to decide whether it is a case of acquisition accounting or a reverse acquisition accounting, that we're going to see very shortly later. This is one thing. Now, another inputs which I like to pin in your minds is when you look at these three kinds of accounting. This is more for your general knowledge now. The concept of acquisition accounting is covered in the main standard. The concept of reverse acquisition accounting is covered in the Appendix B. It is covered in the Appendix B of the standard, and the common control transactions is covered in terms of the Appendix C of the standard. So we can say that there are three different areas which are, where the standard addresses these accounting. So acquisition accounting is discussed all throughout in the main text of the standard. Reverse acquisition is in Appendix B. The guidance on the common control is in Appendix C. So now let me tell you one thing. We will talk about the common control, that is Appendix C, later. We will talk of the reverse acquisition Appendix B later. Right now, my focus is going to be completely on acquisition accounting. So we will understand the parameters also when acquisition and when a reverse acquisition applies. But my concentration for the time being is how does acquisition accounting applies. We'll take care of the reverse acquisition. We'll take care of the common control transactions at a later stage. I hope my thoughts are clear. Okay, so this is one input which I wanted to share you as a thought process to begin with. Now, another inputs at this stage, what we're going to work upon. Now, as I said, I'm concentrating on acquisition accounting. So when I look at the concept of acquisition accounting, so you decided it's an unrelated party transactions and we are applying an acquisition accounting. I have divided this entire acquisition accounting into a 7-step model. This is not given in the standard, but this is only to ease the convenience of thoughts. So we are going to do in a very systematic manner, we are going to go on a 7-step model in terms of acquisition accounting. So once you identify that it is an acquisition accounting, so I'm going to give you a 7-step model in terms of doing this accounting. And caution again, this is not a 7-step model given in the standard. I have created the 7-step model of my own because this will ease the understanding of the accounting. Now, before I give you the 7-step model, it's important to first of all give you something more. Coming back to the example that A Limited got a control over the business of B. So we said that A Limited gets a control over the business of B and you decided it is a case of acquisition accounting. Now, what we're going to give certain names to A and we're going to give certain names to B. So the names which we are going to give to A and B, A is going to be called as legal acquirer. A is going to be called as a legal acquirer and B is going to be called as a legal acquiree. So once you establish that A got a control over the business of B, so we're going to give names to A and B. A will be called as a legal acquirer and B is going to be called as a legal acquiree. I did not say accounting acquirer. I said legal acquirer and B is the legal acquiree. Now, once you establish that, let's assume that A is also the accounting acquirer. How do you establish whether A is the accounting and the legal acquirer? We'll see later. But let's say you've already evaluated and you've reached a conclusion that A is the legal and the accounting acquirer. Ind AS 103 would now say that A is the parent and B is the subsidiary. And the parent, that is accounting acquirer, is now required to put a journal entry in the books of accounts. The accounting acquirer is required to put a journal entry in the books of accounts by virtue of Ind AS 103. So let me tell you what kind of journal entry is done by A Limited on the date of acquisition. This journal entry will be done in the books of accounting acquirer one time. As I said, Ind AS 103 is applicable one time. So A Limited, the accounting acquirer, will do an entry on the date of acquisition. Now, what is the entry? He is going to put the entry net assets of B Limited will be given a debit at a fair value. So A Limited will capture the net assets of B at a fair value in this entry. And he is going to credit the purchase consideration. Let's say I acquired 80% stake. I might get a control because with 80% I can get a control. So the purchase consideration will be given a credit to the extent of the amount paid, 80%. But remember, this net assets is going to be 100%. The moment you get a control over the other company, you become the parent. So I will capture 100% assets and liabilities of B. So the net assets captured in the entry is going to be 100% and the purchase consideration 80%. So we will also credit in this entry what is called NCI, non-controlling interest. A gets a control. Therefore, there are certain investors who do not get a control and they are called NCI, non-controlling interest. What used to call in the intermediate as minority interest. So what used to call as MI, minority interest, is what is called NCI in terms of Ind AS. So now you can see the mathematical parity. PC and the NCI is 80 plus 20, that makes it 100. And the net assets already recorded at 100%. So this is similar to the accounting which you see in Accounting Standard 14. But in terms of Accounting Standard 14, you never used to record any minority interest. But in this case, you can see the net assets are captured at 100%. The purchase consideration, if you paid 80, and the remaining 20% is the NCI. And then any balancing figure in this entry, is going to be called as a goodwill, or you can say a capital reserve. So let me, just connect the dots once again. Because now you're going to get new data every minute. You're going to get some new data. So I said if A gets a control over the business of B, then A is the legal acquirer and B is the legal acquiree. But we need to evaluate certain parameters to decide that A is also the accounting acquirer or not. Those parameters we'll see later. But once you establish that A is the accounting acquirer, he is required to pass an entry on the acquisition date as per 109, and this is called acquisition accounting. So A will incorporate 100% net assets of B at a fair value, record the purchase consideration NCA on the credit side. Any difference is going to be the goodwill or the capital reserve. Now, the idea is to achieve this entry. And the idea is to achieve this entry. So what I've done, I've converted this entire journey. Into a 7-step model. In order to pass this entry, I'm going to give you 7 elements and I'm going to give you 7 inputs in this case. Step number 1, step number 2, step number 3, step number 4, step number 5, step number 6, and step number 7. We go systematic step by step. In the step number 1, we learn the art of identifying who is the accounting acquirer. In the very first step, we will identify who is the accounting acquirer. And let me now tell you something important. In the step number one, please say this carefully. In the step number one, if you decide A is the accounting and the legal acquirer, it's going to be acquisition accounting. I'm talking of unrelated party. So if you say the transaction is between unrelated party and you decide legal and accounting acquirer is same, it's acquisition accounting. But if you decide that A is not the accounting acquirer, but B is the accounting acquirer, in that case, we will apply reverse acquisition accounting. So your very first step will decide the fate, whether it is going to be acquisition or a reverse acquisition. Let me put this again very carefully to you. And I think I'll pen that down also in the previous chart. Now hear this carefully and do vouch me very carefully on this. As I said, there are three kinds of accounting. So I said if it is unrelated, it can be acquisition accounting or a reverse acquisition. And if it is related, it is generally a common control, but it may turn out to be acquisition or maybe a reverse acquisition. But generally, related parties will be a common control unless the parameters fail. So I'm going to put three sentences to you and you need to tell me which kind of accounting would apply. Can I say if it is unrelated party transaction, one, and number two, the legal and accounting acquirer is same. Would you like to tell me what kind of accounting will trigger? So why not to record assets to be to the tune of 80%? Okay, I'll very shortly answer your question as well. But first, I think let me put my three inputs to you. There is a transaction between unrelated party and you reach a conclusion that legal and accounting acquirer is same. So what kind of accounting would trigger? That's right. It's going to be acquisition accounting. Number two, if you say it's an unrelated party transaction, but the legal and accounting acquirer is not same, the legal acquiree becomes the accounting acquirer, then what kind of accounting will trigger in that case? That's right. It becomes a reverse acquisition. And number three, if it is related party transaction, generally it would be which kind of accounting? If it is supposed to be related party, generally it's going to be what kind of accounting? I think that goes without saying that it's going to be a common control. That's right. So now you have understood some broader parameters that when you attack a question and you see it is unrelated party, accounting legal acquirer same, acquisition accounting. When you look at it's a unrelated party, accounting legal acquirer not same, reverse acquisition. When you see it is related party, it's a common control transaction. I think let's pen this down. So we can say, I think I'll just add another slide out here. So we can say, if I want to just, get the dots connected very well. So this is what I'm giving you is generally. This is what I'm saying is going to be generally. Generally, depending upon these parameters, this is what is going to happen. So we can say, if you say that it is a case of acquisition accounting, or if you say it is a case of reverse acquisition accounting, and if you say it is a case of CC, that is common control transaction, I would say the parameter number one is that it's unrelated parties. And the parameter number two is the legal as well as the accounting acquirer is same. So that would generally lead to the conclusion that it's an acquisition accounting. This is that there is a transaction between unrelated party. And I would say the number two is the legal and the accounting acquirer is not the same. The legal and the accounting acquirer is not the same. It's going to be reverse acquisition. And here we can say that if it is related party, but there's no second parameter, in this case, it turns out to be common control. So As we're going to proceed further with the standard and look at some more nitty-gritties, you'll be able to get some more dots connected very well. But this is the basic parameters with which you will be able to decide that we are under which kind of accounting. Great. So let's come back on the agenda. Let's come back on the agenda. So as I said, now we're going to apply the acquisition accounting. So my focus right now is only on the acquisition accounting. So how will you get decided that it is acquisition or reverse acquisition? Once you identify the accounting acquirer, that will decide the fate, whether it is acquisition or it is reverse acquisition. Now let's proceed that it's acquisition accounting. The second focus is to get the date of acquisition. The second focus is to get the date of acquisition, which I put out there as DOA. That is my second step. The third step which I'm going to do is I am going to make a list of net assets acquired. I'm going to make a list of the net assets acquired. So we're going to sit down and make a proper list of all the assets and liabilities. We're going to make a list of net assets acquired. The fourth step we're going to calculate is the purchase consideration, the PC. So we're going to calculate the purchase consideration, and that is the PC. And then the fifth step is in terms of calculating NCI, that's called the non-controlling interest. That's called the non-controlling interest. So we're going to calculate the NCI, that is the non-controlling interest. Then in step number 6, we're going to calculate the goodwill or the capital reserve, as the case may be. And the seventh step is basically, this is the seventh step. Putting the journal entry in the books of accounts is the seventh step. Wow. Let me just connect the dots. We're just creating some background in terms of how we're going to proceed with the acquisition accounting. So let me just get the dots connected very well to you. So as I said, that when you evaluate that A gets a control over the business of B, in this particular case, A becomes the legal acquirer and B becomes the legal acquiree. And I'm now going with the presumption that once you applied the parameters and you decided that A is legal and the accounting acquirer both, then acquisition accounting would apply. And the idea is to achieve this journal entry. The idea is to achieve this journal entry. Since the idea is to achieve this journal entry, now let's have a look. This entry is done in the books of the accounting acquirer. That is my step 1. This entry is done on the date of acquisition. That is my step number 2. The entry is done in the books of accounting acquirer, step 1. The entry is done on the date of acquisition, step 2. You need the net assets, that is step 3. I need the net assets. I need the purchase consideration, step 4. I need the NCI, that is step 5. I will get the goodwill or the balancing goodwill or capital reserve balancing figures, step 6. Once you get the 6 steps, you know in whose books, on what date, what is the net assets, PC, NCI, goodwill, you're able to create the entry in the step number 7. So the idea is now to work towards a step number 7, and for which the 6 steps are the crucial steps. The examiner can give you questions which are independent questions on each of these steps. The examiner can give you a full-fledged question as well. Now I'll tell you, friends, what is my strategy going to be. I will now concentrate on each and every step in a detail. You know the macro level that we need to achieve this entry. So what I'm going to do, I'll pick up each and every step and we'll deep dive in terms of each and every step at this stage. Once we deep dive in terms of each and every steps, automatically if there are any questions on the individual steps, we'll handle that. And then we'll come to the larger questions where all the 7 steps are to be applied. But I know there is still a question pending in your mind that what is this entry of Ind AS 103? How does this acquisition entry help me? I think I'll also connect the dots very soon but not today, maybe not in the next session. I will connect the dots later that what is the role of this entry. But I will at least tell you at this stage that this entry is the bridge between, it's a bridge between the separate financials of the parent and the consolidated financials of the parent. Once you incorporate this entry in the separate financials of the parent, you are going to get consolidated financials. But we'll work upon that in a detail later, not at this stage. For the time being, just consider that this is the acquisition entry and we need to attain this with a 7-step model. So far, so good, friends. Are you absolutely clear with the thoughts? Any questions on your mind, please ask me. Otherwise, I'm ready to go ahead. All good, clear, wonderful indeed. So I have given you now the inputs on the 7-step model. Now we're going to start working on each and every step one by one. So let's begin with the first step, and that is identifying the accounting acquirer. So we are working now on the step number 1. And this is to identify what we call accounting acquirer. This is to identify what we call the accounting acquirer. After going through the standard, I made my own permutations and combinations, and I reached a conclusion that there are various combinations. And I think if you're clear on each and every combination, what is to be done, life jingalala. So what I'm going to do, I'm going to give you a wonderful chart on the basis of which we will decide the parameters on a logical manner that who is the accounting acquirer. We'll see the application of this to various questions as well. Okay, so I'll give you the basic thought processes of identifying the accounting acquirer. I would say you can divide the questions in terms of 2 categories. I would say you can divide your questions in terms of 2 categories. When you look at a question to identify the accounting acquirer, C is a new entity. Is a new entity created or not? So you will first of all put across a question that is a new entity created or not. So did the acquisition result in creation of a new entity? Now you would say, what does this mean that you're creating a new entity? I'll explain. Let's imagine there is a company A Limited. So either the answer is a yes or the answer is a no. So first let's take no, and then we take the answer yes. Now let's take an example to understand that a new entity is created or a new entity is not created. Now when you say the new entity is not created, it's like this. There is a company A Limited and there is a company B Limited, and both these companies are existing companies. Both these companies are existing companies, so no new company is created. So A is dealing with B. So for example, A tells B that it goes to the shareholders of B to acquire the shares of B, through which he'll get a control. So in this case, A and B are existing companies and 2 existing companies are dealing with each other. Then I would say no new entity is created. But if you say a yes, a new entity is created, it could be something like this. There is a company A, there is a company B, and a new company C is created. So A and B are existing companies. So A and B are existing companies, and a new company C is created with the objective C will acquire the business of A and B. So there are 2 cases. You need to see carefully. The transaction is happening between 2 companies which are already in existence. or the transaction is happening between existing and a new company. The new company is planning to acquire the control over the existing company. So first you will look into the question and have a look that is the new entity getting created or not. That will be a simple affair. We'll see in the practical illustrations very shortly. Okay, once you've done that, then in this particular case, we will have two further segregations. So once you've done that, okay, new entity is not created or a new entity is created, then you need to see in this particular case the purchase consideration. You need to see that the purchase consideration is paid in what form? Is it mainly in cash? Or is it mainly in shares? It is mainly in cash or it is mainly in shares. So now what are you going to do? You will start evaluating that the purchase consideration is paid in which form. You need to look at the form of the purchase consideration. Is the PC mainly, I did not say only in cash or only in shares, is the PC mainly in cash or is it mainly in shares? And here also, I will look at the parameters that it's mainly in cash. Or we can say it is mainly in shares. So this is the focus point with which you are going to start looking at to identify the accounting acquirer. So you're going to see that is a new company created or not, number one. And number two, in this particular case, the consideration is mainly in shares or cash. Okay, so this is the basic thought process. Now, how would you apply all this? Let's make a chart. Let's make a chart and give you some logical understandings on this. Let me go ahead. So I'm now going to make a chart and give you some permutations and combinations, the 4 combinations. We're going to work on these combinations one by one. So I am interested now in looking at the 2 inputs one by one, and you're going to help me out with this. And once we've understood this on a logical level, then I think we are sorted. Then we can start doing questions on this area, step number 1. So now my mind is working in terms of, I'm saying, did we create a new entity? And the answer is no, or the answer is a yes. Then I put across another question to myself, and I put another question to myself that the purchase consideration is mainly in what form? We said it is in cash. We said it is in shares. We said it is mainly in cash, or we said it is mainly in shares. Now, I'm going to put some questions to you on a logical level, and you will decide the inputs. Think logically, just apply basic logics, and you will get the answer. Now, we said there are 2 companies, A Limited as well as B Limited, and we are saying no new company, consideration is in cash. A approaches the shareholders of B. A approaches the shareholders of B. I'll not approach B. I'll not approach B. If I want to get a control over B by way of acquiring an ownership interest, I will approach the shareholders of B. Now, I tell the shareholders that I'll give you cash to buy the shares. Does the shareholders of B become the shareholders of A? Yes or no? So when A approaches the shareholders of B and A tells the shareholders of B, I'll give you cash to buy the shares of your company. So are the shareholders of B going to become the shareholders of A? And that's right, no. So can I say if the answer is no, now you need to watch this carefully. Now you need to watch this carefully. Can I say after the purchase consideration is discharged? After the purchase consideration is discharged, can I say A Limited will still be under the control of his own company? Can I say A Limited will still be under the control of his own company? Because I acquired a control over another company by giving the shareholders cash. I have all the shares of my company with me. So can I say A is under a control? He is still under the control. The company was under the control of A Limited shareholders, and the company is still under the control of A Limited shareholders. So in this particular case, we can undoubtedly say the legal and the accounting acquirer 100% is same. Correct? I think makes logical sense. Because if I'm acquiring the control over another company and I don't give them shares in my company, I am the owner of my company. I am still remain the owner of my company. My shares are not getting diluted. My shares are not getting diluted because I am not giving them shares. I'm not making those people shareholder in my company. So I will be in control of my company even after the PC stands discharged. Next. Now let's go to the next combination. In this case, new entity is not created. New entity is not created, but the purchase consideration is paid in shares. Now watch this carefully. Now watch this carefully. Let's say A Limited had 100 shares in his company and B Limited had 60 shares in the company. Watch this carefully. So A had 100 shares in the company, B had 60 shares. A approaches the shareholders of B and tells them that I'll give you 1 share for every 1 share. A approaches the shareholders of B and tells them that I'll give you 1 share for every 1 share in my company. Does the shareholder of B become the shareholders of A? Yes. This will dilute the percentage held by the shareholders of A? Yes. Because if you're going to give shares to the shareholders of B, they will also become the shareholders of A. So A's shares will go partly to the shareholders of B. The percentage of shareholders of A will get diluted. Let's see. Can I say now if you calculate the status, the shareholders of A have got 100 shares in the company, but the total share capital becomes 160. Because the shareholders of A have got 100 shares in the company, but once A gave 60 shares to the shareholders of B, the total capital base of the company is become 160. And if you calculate the percentage in this case, now the shareholders of A have got 100 shares out of 160. Now they've got 62.5% stake. Can I say he is still in control of the company? Can I say he's still in control of the company? In spite of giving shares to the other company shareholders, the percentage gets diluted, but it is still more than 50%. You're still in control of your company. So if you're still in control of your company, then legal and accounting acquirer is same. It becomes a case of acquisition accounting. Did you get the point? I hope, friends, I'm clear on the point, which means you need to understand what is the percentage post the issue of shares. Once you issued the shares to the shareholders of B, they will become the shareholders in your company and your percentage will definitely dilute. But you need to see the level of dilution. If the level of dilution is still keeping you more than 50%, you're still in control of your company and it is a case of acquisition accounting. Now let's give you something more, friends. Now try this out. Let's give you something more. Let's say if the exchange ratio is, let's say 2.5:1. Let's assume that the ratio of exchange is 2.5:1. How many shares did you give to the shareholders of B? Can I say you told them that I'll give you 2.5 share for every 1 share in the company. So against 60 shares, you'll end up issuing 150 shares to them, correct? So now what is the total capital of A? Shareholders of A has got 100 shares in the company and the total capital base now becomes 250. Because they have 100 shares in the company, they give another 150 shares to the shareholders of B. Now what is the percentage stake of this shareholder? Can I say by issuing another 150 shares, they are left with 100 out of 250. He's got a 40% stake in the company. He's lost control. He's lost control of his company. Can I say if he's got lost control over his company, then the legal and accounting acquirer is not same. I gave a percentage. Now hear this. I gave a percentage of shares. I gave the shares to the other company in such a way that I give the share, but I lose the control. They get the shares and they get a control over my company. Wow. So you pay the consideration in such a way that the company, the shareholders who get the shares, get the control as well. So in this particular case, we can say the legal and accounting acquirer is not the same. It is a case of reverse acquisition. Moral of the story so far. Moral of the story so far, let me just put the inputs to you. If a new company is not created, I'm putting some MCQ now. If a new company is not created and the purchase consideration is in cash, it can never be reverse acquisition. Right or wrong? You said it's a reverse acquisition apply. That's right. So that is absolutely correct. If a new company is not created and the purchase consideration in cash, it can never be a reverse acquisition because you never made those people the shareholders in your company. Then you don't lose any control. Your control doesn't even get diluted. So the moment you read a question that the PC is in cash and new company is not created, I'm safe. I can say the acquisition accounting would apply. The legal accounting acquirer is same. Second, can I say if a new company is not created and the percentage and the consideration is in shares? Depends. It may be a case of acquisition accounting. It may be a case of reverse acquisition. You need to calculate a percentage and identify. Agreed? So once you look into the parameters that you gave shares, you need to see that the percentage post acquisition is how much. If the percentage gets diluted, but you're still in control, it's acquisition accounting. But if your percentage gets diluted to an extent that you lose control of the company, it's reverse acquisition. So it may be acquisition, it may be reverse acquisition. Great. Next. Now let's look at the next combination as well. Okay, so I think that is very well rightly answered in this case. Then he said the shareholders of B is in reverse acquisition. That's absolutely correct. Okay, let's go to the next one now. Now I am looking at that a new company is created. So there is a company A Limited and there is a company B Limited. These are existing company and a C Limited is formed to acquire the business of A and B. Now let me ask you point blank. If a new company is created and it will give the consideration to the shareholders of A and B in cash, will the shareholders of A and B become the shareholders of C? Yes or no? If you create a new company and this new company is going to give the shareholders of A and B purely cash, then shareholders of A and B do not become the shareholders of company C. So C will be in full control of his own company. So in this case also we can say the legal and the accounting acquirer is going to be the same. It's going to be acquisition accounting. And now comes the interesting point, and you need to vouch me carefully on this. Now, in this case, same example, there is a company A and B, existing company, and a new company C Limited is created to acquire the business of A as well as B. Now, watch this carefully. Watch this carefully. In this particular case, let's say C Limited had a total of 1,000 shares. And out of this, 600 shares is given to A. And out of this, 400 shares is given to the shareholders of B. Watch this carefully. So I'm saying that C Limited is created with 1,000 shares. If C Limited is created with 1,000 shares and out of this 600 shares goes to A shareholder and 400 shares goes to B shareholder, Is A Limited getting a 60% stake in C? Is he indirectly getting a control over C? What do you say? Can I say in this particular case, A shareholders have got a 60% stake in this company? Good. So we can say A Limited in this case is getting a 60% stake in C. If he's getting a 60% stake in C, then legal and accounting acquirer cannot be same. It is undoubtedly a reverse acquisition. Let me make another stronger statement. Let me make another stronger statement as well. If a new company is created and the consideration is mainly in shares, either of the existing companies will get a control or maybe a combined, there is a joint control. It's always going to be a reverse acquisition. Watch me carefully. So I'm saying in this particular case, either A will get a control over C or B will get a control over C, or maybe A and B together get a joint control. It'll 100% be reverse acquisition because A or B or both put together will get the shares of the company C. So either A gets a control or B gets a control or A and B together get a joint control. It'll always be a reverse acquisition. And that's correct. So I think I've now decided some parameters on this. Getting complicated? You must be thinking at every new stage, new inputs coming in. Since morning, a lot of new information is coming in. So let me just quickly connect the dots now based on this chart and condense it further before we do questions with you. So before we do the questions, I think let's connect a few dots once again. So cannot understand this case. Can you please explain this again? Okay, let me just explain that case once again to you. Now, let's have a look. Now, let me first ask you a very basic question. If you create a new company and this new company gives the shareholders of A and B shares, are all the shares of C ultimately going to go to the shareholders of A and B? Yes or no? If C is going to give the consideration in shares, are all the shares of C ultimately going to go to A and B shareholders? Yes. So ultimately, whosoever gets a majority share gets a control over the company. If A gets a majority, A gets a control. If B gets a majority, B gets a control. If they get equal shares, they get a joint control. So ultimately, the shares of C being with A and B, either A or B or AB combined will get a control or a joint control. So it will never be acquisition accounting. It'll always be a case of reverse acquisition. Got the point, I guess? Clear with the agenda? So we have now reached some important conclusions at this stage. Let me put this out. Okay. So I'm now just going to pen this down. I'm going to make some few statements and you need to vouch me. I'm going to make some condensed, statements on this and you got to vouch me on that. So I am thinking that if I want to make simply a small little summary chart, condense it further and make a small little summary chart, I would put it like this. You see, the purchase consideration is in cash or the purchase consideration is in shares. Let's go the reverse gear now. Let's go the reverse gear that the purchase consideration is in cash or the purchase consideration in shares. Now let me make a statement. If the purchase consideration is in cash, can I say whether a new entity is created or not? Can I say I don't care? Tell me yes or no. Tell me yes or no. So, but sir, if A gets a control, it should be acquisition accounting. No. C is the legal acquirer in that case. If C is the legal acquirer, he doesn't become the accounting acquirer. A and B are the legal acquirees in that case. Correct? So my input is if the PC is in cash, I don't care whether a new entity is created or not. Can I say it'll always be acquisition accounting? Agreed. Now clear? Okay, that's great. So can I say in this particular case, it'll always be a case of acquisition accounting because in this case you can undoubtedly say the legal and the accounting acquirer will never be different. Because if you're not giving shares to the other people, other shareholders, they will never become shareholders of your company. Your control can never get diluted. Correct? Great. Now let's have a look on this. Can I say if a new company is created, then I am definitely deciding that whether a new entity is created or not. Now it's important. Can I say now it's important? Now it's important for me. I cannot say I ignore this input. So let me now put it like this. So if you say that a new entity is created, if you say a new entity is created, can I say always a reverse acquisition? What do you say? So in this case, can I say it is always a reverse acquisition? So this will always be a case of reverse acquisition in this case. Because in this particular case, if a new entity is created, the shares of the new entity goes to the existing companies only. The shares of the new company goes to the existing shareholders only. So one of the two or both of them will get a control over the existing new company. So it'll always be a reverse acquisition, which means the legal and accounting acquirer in this case will never be the same. The new company is the legal acquirer, but he will never become the accounting acquirer. Then comes the other case. If you say new entity is not created, can I say it depends upon? Can I say it depends upon the percentage post? It depends upon the percentage post discharge. Once you give the consideration, you need to see the percentage and decide. It may be acquisition accounting, it may be reverse. Life made simple. Now, your approach to the question in terms of identifying the accounting acquirer is going to be same. 3 parameters to be applied. I read the question, the PC is in cash. I'm decided it is acquisition accounting. I read the PC is in shares, a new company created. I've decided it is reverse acquisition. I read the question and I see new companies created. No new companies created. I'll say, okay, let me check. Let me check the percentages. If the percentage is diluted, it's reverse acquisition, otherwise acquisition accounting. I hope, friends, I stand very clear on my step number 1, the basic summary chart, everything clear. So new company created and the PC is in cash, then it is acquisition accounting? Yes. If a new company is created, I said I'm not concerned. I don't care. I don't care in that case whether a new company is created or not. It's simply going to be acquisition accounting. The concept is very simple. PC cash, we decided no evaluations required. Acquisition accounting. Create a new company, don't create a new company, it doesn't make a difference to me. It is only when the PC is in shares we need to be cautious. But if you create a new company, it's always reverse acquisition. But if you don't create a new company, then you need to evaluate on the percentages. I think, friends, before we proceed further, let's get your comfort zone scores on a scale of 10. So give me your scores on a score of 10 regarding your comfort level on the agenda so far. I get 10 out of 10, 10 out of 10, 9.5 out of 10. Okay, I'm also getting a question. So in the cash, how new company is created without a share? I have a doubt on that. You may issue the shares to others, outsiders, but you don't give it to A and B. You create a company, but those shares are given to the shareholder, given to people other than the shareholders of A and B. So you don't give the shares to A and B shareholders, but somebody else in life. Correct? Okay, that's wonderful indeed. So I think so far so good. Everybody's quite comfortable with that. Now we are, I think, in a position to do some questions on this area from the study material. So let me now go to the study material. So we're going to apply this inputs in the questions given in the study mat. So let me, I guess, come to the inputs on this case. We'll take some few examples as well, and then we'll maybe get into a little more complications. Let's come to example 8 and 9, which is given in the study mat. Chapter number 12, example number 8 and 9. Let me know, friends, if this is visible to you. Example 8 and 9 in the study material. I hope that's visible. So let's read the example 8 and 9. We'll go to complicated example also, but first let's read example 8. It says company A and company B operate in the power industry and both entities are operating entities. If they're both operating entities, that means they're existing companies. So I am given that these are existing company. So that is my focus point number 1. It says A has got a much larger scale of operations than B. Company B merges with A such that the shareholders of B would receive 1 share of company A for every 1 share in B. So we can see the purchase consideration is mainly in shares. I think before we read further, quick question. No new company is created, but the purchase consideration is in shares. Can I say depends? I'll have to see that the percentage gets diluted to an extent whether lose control or not. Is my thought correct? Good. It says such issue of shares would comprise of 20% issued capital of the combined entity. So if they land up issuing 20%, so can I say the existing company, the acquirer, the legal acquirer will still be having 80% stake in the company? Because if I land up issuing the shares in such a way that the shareholders of the acquiree will get a 20% stake in my company, so I'm still in 80%, still in control. Tell me which kind of accounting would apply. I'm still in control, so tell me which kind of accounting would apply. Acquisition accounting or a reverse acquisition? Even after giving the shares, my percentage gets diluted, but only to the extent of 20%. I still have 80% control. That's right. It's acquisition accounting. It says after the discharge of the PC, the pre-merger shareholders of company A has got 80% capital in A. So it is undoubtedly a case of acquisition accounting. So we can lead to the conclusion that this is undoubtedly acquisition accounting. We'll still read further. In this transaction, company A is the acquirer for the purposes of accounting for business combination. This is because by merging the entire shareholdings of B, A has got a control over B. Further, the shareholders of the erstwhile company, that is B, do not obtain a control over A on account of shares received in PC as they had only 20% paid up capital of A. Simple. So if you're able to apply the parameters correctly, no new company created, and the consideration is mainly in shares, we decided the percentage and decided the agenda. Example 9. It says company A and company B operate in the power industry and both the entities are operating entity. That again indicates that they are existing companies. So they are existing companies, same data. It says company A is much smaller scale of operations than B. Company B merges with A such that the shareholders of B would receive 10 shares of A for every 1 share in B. I always tell people another thing. Look at the exchange ratio. If it is too adverse, in the previous one, it was 1:1. Now it's 10:1. You're telling the person, I'll give you 10 shares for every 1 share, which means I have all the intentions of making him the owner of my own company. So we'll give them 10 shares for every 1 share. such issue of shares would comprise 70% issued capital of the combined entity. So can I say in this particular case, the existing shareholders will get only 30% left over? Can I say they will lose control? Can I say if they will lose control, what do you say? Is it going to be acquisition accounting or reverse acquisition? No new company is created and the purchase consideration is only in terms of shares, but you lose the control. You get only 30% in the combined entity. Super. So this is going to be a case of a reverse acquisition in this case. And you can see one thing very clearly as well, that nowhere I'm given that they are related parties. Unless they are related parties, the concept of common control does not arise. If it is unrelated, it's either acquisition or it is a reverse acquisition. It is only if it is related, then it can be common control. If not, then they could turn out to be different. But we'll see that later. Then he says, after the discharge of the consideration, the pre-merger shareholders of company A has now got 30% capital of A. Post-acquisition, the management of B would manage the operations of the entity. In this transaction, B is the acquirer for the business combination. Okay, that was great, simple and straight. Let's, I think, take this further as well. Let me just crop this out. So this might be slightly, okay, I think I'll maybe cut this out so we can maybe, focus on the question more. So this is example 9 continued. Then there is a further illustration 6, which is interesting. Okay, first we'll say that company B, the erstwhile company B, would get a controlling interest and management, and as such in substance. So the concept of identifying the accounting acquirer is looking at the substance over the legal form. Because we want to see that in substance, who is the accounting acquirer? So B got the control over A, though he is a case of a legal acquiree. It is important that company B will be considered as an acquirer for accounting purposes only. For legal purposes as well as for reporting purposes. Now see, for legal and reporting purposes, A will be considered as an acquirer. So it is very important to understand that from the point of view of accounting, it is important who is the accounting acquirer. But from the legal perspective, reporting perspective, which means, let me clarify. In my example, A is the legal acquirer, though he did not become the accounting acquirer. But the obligation to present a consolidated balance sheet still lies upon A, because he's a legal acquirer and for the purpose of presenting. Because when it says financial reporting purposes, that means for the purpose of presenting a consolidated financials, A will be presenting a consolidated financials, though he is not supposed to be a legal acquirer. It is only from the point of view of entries to be recorded, we will say that B is the accounting acquirer, but A for the purpose of financial reporting, that means for presenting a consolidated financials and from legal perspective remains the legal acquirer. Okay, so that was simple. So we saw the case where a new entity is not created. I think there is no point looking at a question where the PC is in cash. Whether you create a new entity or don't create a new entity, that is simple, because if the PC is in cash, it can never be a reverse acquisition. So the questions we are focusing is on the PC in shares. No new entity? Now let's see a new entity. Let's look at illustration 6. It says ABC incorporated a company Super. When you incorporated a company, that means you created a new entity. Now, everything depends upon whether the consideration is in cash or the consideration is in terms of share. So, ABC incorporated Super to acquire 100% shares of entity Focus and therefore to get a control over Focus. Now, watch this carefully. To fund the purchase, Super Limited acquired a loan from XYZ Bank. The loan funds are used by Super to acquire the entire voting shares of Focus. Did I pay the consideration in shares or did I pay in cash? The company took a bank loan, and with the money from the bank loan, they got the control over the company Focus. So, did the PC pay in cash or the PC is in shares? That's right. So, we can say the purchase consideration is in cash. Can it be a reverse acquisition, or can I outrightly say that this is going to be a case of acquisition accounting only? New entity created, PC is in cash. Therefore, in this case, it is undoubtedly acquisition accounting. Super. Then he says, post the acquisition, Super also has the ability to elect, appoint, or remove a majority of the members of the governing body. Let me tell you, once we come to Ind AS 110, you will see that the aspect of control, we also consider that as a person having a control, you should also be, you may also get a control by virtue of appointment and removal of the key management person. If as an investor, I get the right to appoint, remove the key management person, the people sitting in the board of directors, I can get a control as well. So when it says that he gets the ability to elect, appoint, or remove the key management personnel governing body, we can say he definitely gets a control. Super A management is in power where it will be able to dominate the management of Focus. So I think everything goes in favor of Super. So whether Super will be identified as the acquirer in the business combination, the answer is a big yes. It's going to be a case of acquisition accounting. Is going to be a case of acquisition accounting in this case because the PC is mainly in terms of cash. Now you can see the third combination coming in. New entity PC is in cash. Now let's go further. So let me just, I think, take this. Okay, this one I don't need. We'll go to another interesting question. Okay, I'll just add another question to you. I'm carrying another question with me, which is a very interesting one. Let me just share a question from my side. I've just added another question on my own as well. So there was a small little question which is there. I think even I have not taken that. Okay, let me do one thing. Let me just, I think, share that question on the screen to you maybe. I think that would be better, I guess. I'll just probably share a question. Okay, I've got a question as well. So if A is the legal acquirer, presents a consolidated financials, then what's the point of accounting acquirer? Okay. The acquisition entry is done by the accounting acquirer, even though the consolidation will be presented by the legal acquirer. Now, how will this get accounted for? We'll see later. But I think you'll get the inputs. If you say it is a reverse acquisition, then you can say the obligation to present the consolidation is on the legal acquirer, but the entry will be done considering the substance of a legal form. So the entry will be done in the books of B as an accounting acquirer, and the consolidation will be presented by A. And that's the fun. How does a reverse acquisition gets accounted for? That's what we need to see. So we'll see that when we come to the guidance which is given in the Appendix B, that if it is a reverse acquisition, how does it get accounted for? So don't get worried of that. That will be taken care later, right? Okay, so let me just share a small little question, friends, to you at this stage. Just give me a minute. I will share a small question, and that will be an interesting treat to watch. Just a second. So this is one of the questions which is there in the education material as well. And I think it's a very good question indeed. But I want to definitely, take it across to you. Just give me a second. I'll show that to you. Okay. So let me share the inputs to you. So there will be two parts to this particular question. So we're going to look at the part number one, the part number A first, and then see the inputs after that. Yes. Let me share the question on the screen. Have a look at this question. We're going to decide whether it is a case of acquisition or a reverse acquisition. Let me read the inputs now. It says ABC incorporated a company Super. So we can clearly see that there is a new company created to acquire 100% shares of another entity Focus and therefore to obtain a control. I think this one we have done. Okay, this is what we exactly just did. That was in the study. I'll show you an extended version of this. I want to basically show you another extended version. So let me share another part to this. Though it is a different one. Yes, here we can have a look on this. Let's, I think, read this part. Now, this is different facts altogether. It says to capitalize on the economies of scale and another synergy, entity Q contributes its wholly owned subsidiary, entity X, and entity R contributes the wholly owned subsidiary, that is Y, to a newly incorporated company Super. I think the language is a bit technical. Let me explain that part as well. What is happening in this particular case is the two companies are basically selling their own subsidiaries to another company. Now, read this as if when it says contribute means that he is selling his own subsidiary. So it says Q is going to sell its wholly owned subsidiary X. R is going to sell its wholly owned subsidiary Y to a company called Super. So Super is basically acquiring entity Q from entity X, and Super is also acquiring the entity Y, the entity R, which is the subsidiary of Y. Then he says Super will issue 200 shares to Q and 100 shares to R. So by acquiring these companies, the purchase consideration is being given in the form of shares. So they're giving 200 shares to the entity Q and they're giving 100 shares to the entity R in exchange of the respective subsidiary. So the two companies, entity X as well as entity Y, are selling their subsidiaries, and in lieu, they're getting shares in the new company, that is Super. Then he says the number of shares reflects the relative size of the entity before the combination. Can Super be identified as the acquirer in a business combination and apply the acquisition accounting method in its consolidated financials? If Super is not the acquirer, then which entity is considered as an acquirer, and show how the combination be accounted for? So my question to you, in this case, would you help me to decide, is Super the new company created, the acquirer, or is it somebody else? And if it is somebody else, which is that company? So let's get your answers on that. Evaluate, decide. I think I would have got the answer so far. Yes, I've started getting the answer. Super is not the acquirer. Entity Q is accounting acquirer. Entity Q is the accounting acquirer. And that is very rightly said. Good. That's wonderful indeed. I think I'll still like to, show you some inputs at this stage. So let me just, I think, still work it out. Maybe at the beginning. so that everything remains in the same order. So I'll still just give you a quick visualization in this particular case. So this input which I gave you, just let's quickly visualize. So the facts of the case which I gave you, I'll just keep that in front of me. So we can say that there is an entity Q. There is an entity Q. It has got 100% wholly owned subsidiary, that is entity X. And then there is another company which is supposed to be entity R. There is a company entity R, and this has also got a wholly owned subsidiary, that is entity Y. So these are the two companies, X and Y. They are wholly owned subsidiaries of these two companies. Now, what is happening in this case is that Super is approaching to buy this company and to buy this company, and the purchase consideration is in the form of shares. And how many shares is he giving? So we can see that entity Q is given 200 shares in Super. So he gets 200 shares in Super, and he gets a total of 100 shares in Super. So which means he gets a 67% stake and he gets a 33% stake. So that's what we can see. So I think if I just now connect a few dots in this case, we can clearly see that is the new company getting created? Yes. So new entity is getting created. The purchase consideration is in the form of shares? Yes. So can I say 100% it's a reverse acquisition? Because we decided if you create a new company and the PC is in shares, it is undoubtedly a case of a reverse acquisition. So keeping these two factors into account, it is undoubtedly a case of a reverse acquisition. In this particular case, we can see that Q is getting a 67% stake in Super. So we can say in this case, Q gets control. Q gets control over Super. So if he gets a control over Super, we can say it is undoubtedly reverse acquisition. Q is the legal acquiree, but he becomes an accounting acquirer in this case. Great. So I think all my permutation combinations on the step number one is done. I think we have done a deep dive in terms of the step number one. We've seen the basic conclusion is your focus point is PC. The focus point is PC. And when we go look at the larger questions also, trust me, we're going to go back and look into these parameters. So when the PC is in cash, I'm safe. I'm not even considering new company created or not. We will simply say this is a case of acquisition accounting. If a new company is created because the shares PC is in shares, then you need to go to the second layer to see that is the purchase consideration, is the new company created or not. If the new company is not created, it is a subjective assessment. All depends upon the percentage post-business combination. But if your new company is created, undoubtedly it is a reverse acquisition. Right, friends, my step number one is done. Now my focus is on the step number two. But I think before we go to the step number two, I think it's time to give you some break to relax your minds. Step number two is pretty easy. I think the main inputs will start on the step number three. So I think let's first give you a small break, 10, 12 minutes, relax your minds, and then I'll start my journey on the step number two, which is identifying the acquisition date. Right, so far so good. I think any questions? No questions on this. Okay, wonderful. Right, friends, so we'll take a break and we'll start back. Relax your minds. Okay, thank you. Friends, I hope you had a relaxation of mind. So we are now on the second step with you. The first step is done. Now we are on the second step, identifying the date of acquisition. Now, one would think that, what's the big deal in terms of acquisition date? That's not a very complicated process. Of course, it is not, but there can be some interesting issues which can arise. Let's, I think, start working on the. The moment I said interesting agendas, I think there seems to be some technical thing. Okay, I think I'm getting a message. So good morning. And two, they are placed in revision lectures tab by mistake. Oh. It would be benefit if you can share it on the other students. So you're the best, sir. I study in the evening due to lack of time. Thank you. Okay, sure, I'll do that. Thanks for pinpointing that. I think somebody else, I think Ayush was also asking me that, where are the questions on the class 1, 2, and the financial instruments. I'll upload that maybe, I think by mistake. I've uploaded them on the revisionary part. I'll upload them on the regular part as well. Thank you very much for the inputs, Abhishek. That's nice of you. Okay, so let me, I think, come to the inputs as far as the acquisition date is concerned. So I'm just going to share. Let me cut this example. Okay, let's first have a little inputs in terms of what the standard states. Let me just come to the inputs and let's first read the inputs. We'll make some interesting chart on this as well. It says acquirer shall identify the acquisition date. Now, what is the acquisition date? It is the date on which it obtains a control of the acquiree. Now, if somebody says, what is a date of acquisition? So we can say the date of acquisition is the date when the acquirer gets a control over the acquiree. But then the next question comes in, what is the date when the control is acquired? Generally, it is a date when the purchase consideration is discharged. Let's read further. The date on which the acquirer obtains a control is generally the date on which the acquirer legally transfers the consideration, acquires the asset, assumes the liability. And that is called a closing date. Now, please hear me carefully, because this might create a little confusion as I speak further. If somebody says what is a date of acquisition, I would say a date of acquisition is when you obtain a control. If somebody says what is the date when you obtain a control, I would say the date when the purchase consideration is discharged. And I would say this date is also called a closing date. So date of acquisition is also called a closing date. So we can say what is the date of acquisition? When you get a control. When do you get a control? When you pay the PC, and that is called a closing date. Now, it gives you an exception. However, the acquirer might obtain a control on a date that is either earlier or later than the closing date. Oh my God. So there are three cases which are coming to the mind. Ideally, now please say this carefully, we'll document the notes later. Ideally, you can say the acquisition date and the closing date is same. What is a closing date? A closing date is the date when you obtain a control. A closing date is the date when the PC is discharged. But then he gives you two exceptions, that acquisition date could precede the closing date, acquisition date could succeed the closing date. It says that the date on which you get a control might be earlier or later than the closing date. For example, the acquisition date precedes the closing date if a written agreement provides that acquirer obtains a control of the acquiree on a date before the closing date. An acquirer shall consider all the pertinent facts and circumstances in identifying the acquisition date. Sir, we are confused. What is this combinations coming to? No worry. Now let me, I think, first pen down the thoughts, and then we're going to do some case studies, also illustrations, to get this very clear. So what I'm going to do, first of all, to begin with the input, let's come to the step number 2. Let's come to the step number 2. And in terms of step 2, we're looking at the determination. We're looking at the determination of DOA. When I say DOA, you'll get it that it's date of acquisition. It's called the date of acquisition. Now, please hear me carefully. This is a crucial point. When I say what is the date of acquisition, I would say date of acquisition is when acquirer obtains control. When acquirer obtains control. So if somebody says, what is the date of acquisition? I would say the date when the acquirer obtains a control. Then I put across a question. When do you acquire a control? Generally. So, and somebody put me a question that when you obtain a control, I would say generally. Generally, you get a control when purchase consideration is discharged. When purchase consideration is discharged. So get the chain very clear. Acquisition date is the date when you obtain a control. And somebody said, okay, when do you obtain a control? I said, generally, when your PC is discharged. And this date is called a closing date. This date is called a closing date. That means when you pay the PC, that is called the closing date. So ideally, your acquisition date and closing date is same. This is the date of acquisition. So this is the date which is called the date of acquisition. So if somebody says, what is a date of acquisition? It is a date when you get a control. And I said, okay, then what is the date when you get a control? I said, generally, you get a control when the PC is discharged, which brings us to a very important agenda. And that is a total of 3 permutations and combination. I would say the first combination which comes to the mind is the date of acquisition equal to the closing date? Yes. And this is the case generally. It is always like this. The date when you get a control and the date when the PC is paid is the same. The date of control is acquisition date. The date of PC is closing. So generally acquisition date, closing date is same. But there is an exception. So we can say there are 2 exceptions. You can say that there are a total of 2 exceptions. One is the date of acquisition is before. One is the date of acquisition is before the closing date. So one is that it is before the closing date. And the second exception is the date of acquisition is after. The date of acquisition is after the closing date. I hope, friends, you're able to now get the inputs very clear. We'll take examples also, no worry. But I hope you're able to connect the dots, first of all, that when you look at the date of acquisition, the day the acquirer gets a control is acquisition date, finish. Generally, it is a date when the PC is discharged. So the date of obtaining the control generally coincides with the date when the PC is paid. But the date of acquisition can be before the PC discharge, or it can be after the PC discharge, which is called a closing date. So these are the two exceptions. But let me tell you something now. If you look at this particular exception, that is exception number 2, that the date of acquisition is after the closing date, this is practically doesn't even exist. Though it's written in the standard, and this is a concept which used to be called as a convenience date. It used to be there. It used to be there practically, but now it doesn't even exist on a practical level where you can say that you paid the PC, but your acquisition date is still not arisen. So I think we're not looking at this exception because even from the practical world point of view, this does not exist. So we'll not look into this exception. We're only going to look at this exception, that when does it happen? When does it happen that your date of acquisition is preceding the PC? You've not even paid the PC, but you get a control. And this is when? By a written agreement. We're very clear that by a written agreement. So this happens that when by a written agreement, acquirer gets control. Acquirer gets control over acquiree. Acquirer gets a control over the acquiree. So there is a written agreement through which the acquirer obtains a control even before making a purchase consideration payment. Did you get my thought processes clear, friends? Is my thoughts clear? Are you able to correlate the input? Great. So I'm going to make another summary chart after a few questions are done. So because let me also tell you that if there is a written agreement, it may not necessarily involve that, the control is passed on. So what I'm coming to an exception to this. Oh, so you mean to say exception ka bhi exception. You got it correct. So which means that the acquisition date can be before the PC payment. That is this case. But sometimes there may be a written agreement, but still the control may not pass on. So we'll see those things, then we'll make a summary chart after the illustrations. So I think with this combination, let's have a look at a few questions now. So let me, take you to a few illustrations now in the study material pertaining to the concept of acquisition date, illustration number 7, 8, 9. I hope, friends, that is visible, good enough to see. We'll see illustration number 7, 8, and 9. So let's come to the illustration 7 first of all. Can acquiring entity account for a business combination based on a signed, non-binding letter of intent, where the exchange of the considerations and other conditions are expected to be completed within 2 months? A and B sign an agreement, non-binding in nature. It says they sign a non-binding letter of intent. The consideration is going to be paid 2 months later. Do you think I can say the control is obtained? Today, you intend that I will acquire your business, but it's non-binding on me. I may not acquire a control. I may not discharge the PC. It's a non-binding letter. Though it is signed, but it's non-binding. So if it is non-binding in nature, I don't think so we can say that the control in this case can arise, because you can always take a U-turn in this case. So it says the answer is a no. As per the requirement of the standard, a non-binding letter of intent does not effectively transfer the control and hence cannot be considered as a basis of determining the acquisition date. In this case, unless the consideration is paid, we cannot say that in this case the acquisition date is arrived. So that becomes more like a clarification that even if there is a signed letter of intent but non-binding in nature, in that case we cannot consider that to be a date of acquisition. Next, let's go to the illustration number 8. It says on 1st April, X agrees to acquire the shares in an all equity deal. Then he says, as per the binding agreement, X will get effective control on 1st April. There seems to be a written agreement which will give the control to the acquirer. So it's a binding agreement this stage. However, the consideration will be paid only when the shareholders' approval is received. So he says the consideration is going to be paid at a later date only when the shareholders' approval is obtained. The shareholders' meeting is scheduled to happen on 30th April. If the shareholders' approval is not received for issue of new shares, the consideration will be settled in cash. Now let me ask you something. It says that 1st April we got a control because of the written agreement, but the purchase consideration discharge is subject to the approval by the shareholders. But do you think this approval is something which is substantive, is something which is major? Do you think if the shareholders' approval is not obtained, we're going to call off the deal? No, we're not going to call off the deal. We're only going to change the mode of payment. Instead of shares, we'll give cash, but the takeover will definitely happen. And if the takeover will definitely happen, that means the approval of the shareholder is not something which is substantive in nature. And if it is not substantive in nature, in this case, the date of acquisition can precede the closing date. The consideration can be paid later, but since the control is obtained by a binding agreement and the approval is non-substantive in nature, it can proceed. Correct? So in this particular case, we can come to the input, yes, it's before the closing date. The acquisition date in this case is 1st April because in the above scenario, even if the shareholders don't approve the shares, the consideration is settled by payment of cash. Wonderful. Let's look at another one, illustration number 9. It says ABC acquired all the shares of XYZ. The negotiations commenced on 1st January X1 and the agreement is finalized on 1st March X1. While ABC obtains the power to control on 1st March, the agreement states that the acquisition is effective from 1st January X1. The control is acquired on 1st March, but the agreement says that it is going to be effective on 1st January and that ABC is entitled to all the profits after that date. In addition, the purchase price is based on the net assets on 1st January. So what is the date of acquisition? Do you think it is 1st January or do you think it is 1st March? He says the control is coming on the 1st of March. Even though in this particular case, it says the agreement states that the acquisition is effective from 1st January, I think I don't care. Because the control, what is important is the control comes on what date. So even if the agreement says that I'll give you profits, I will, take the position of the net assets on the 1st January, it doesn't make a difference in this case. So in this particular case, the acquisition would remain on the 1st of March. Let's, I think, read this. So let me just crop this bit. I'll just probably come to the main part of the question. So I'm coming to the main solution part. So in this particular case, we can see, notwithstanding that the price is based on the net assets on 1st January and the shareholders do not receive any dividends after that date, the date of acquisition will be 1st March. It is only on 1st March and not on 1st January that ABC gets the power to direct the relevant activity. So in this case, the date of acquisition is going to be on 1st March X1. Now we're coming to some very interesting observations, which I'll put in my summary chart, incorporating the learnings out of these illustrations. Let's now go to the next one. This is an interesting one. It says ABC and XYZ are manufacturers of rubber components for a particular type of equipment. ABC makes a bid for XYZ business and the Competition Commission of India, CCI, announces that the proposed transaction is to be scrutinized to ensure that the competition laws are not breached. Even though the contracts are made subject to the approval of the CCI, ABC, XYZ mutually agree the terms of the acquisition and the purchase price before the competition authority clearance is obtained. Now, let me ask you something. Do you think the clearance of the Competition Commission of India in this case seems to be something substantive, something major, or do you think it's a mere formality? Unlike the shareholders' approval, which was a mere formality, because even if the shareholders do not approve, in that particular case, can I say the PC would have been paid in cash? But what happens in this case? If the Competition Commission does not give you a clearance, can I say the deal cannot occur? If the deal cannot occur, do you think in spite of the binding agreement, the mutual agreement, do you think my date of acquisition can precede my closing date? I would say no. So what I'm coming to the input is that even if there is a written agreement, you need to scrutinize the written agreement to see that if there is any kind of approvals required, are those approvals substantive or not? If they are substantive, your date of acquisition cannot precede the closing date. But if they are not substantive, then your date of acquisition could precede the closing date as well. Let's read. Can the acquisition date be the date on which they agree the terms, even though the approval of CCI is awaited? Assume that the approval of CCI is substantive. It is something which is major in nature. And I think if it is major in nature, we cannot. If it is major in nature, we cannot in this case consider the inputs. Let's, I think, read. So in this case, if I look at the facts, it says, I'm just coming to the inputs. Since the CCI approval is a substantive approval, ABC to acquire control of XYZ, the date of acquisition cannot be earlier than the date on which approval is obtained. This is pertinent given that approval is considered to be substantive and accordingly, the acquisition is completed only on receipt of such an approval. Moral of the story. Now, what is coming in the back of the mind? I'm going to make some statements to you and you need to vouch me. I'll give you around 2-3 statements. You vouch me. Then I'm going to make a summary chart on my step number 2. There's nothing much in terms of step number 2, but we'll make a very interesting summary chart on that. Now, let me make 3 statements. Statement number 1. The control is obtained on a particular date. In spite of that, the agreement says that it'll be effective before that. Will I consider that? Yes or no? The control comes on a particular date, but they still make an agreement saying that we will get a control retrospectively from a particular date. Will I consider that or will I ignore it? And that's right. We're simply going to ignore that input. As we saw in one of the illustrations, that the control is obtained on a particular date, but still they make an agreement that they will get retrospective control. They cannot. Next, the second statement is there is a mutual agreement giving a control, but it is subject to approval. There is a mutual agreement that it is subject to control. Sorry, there is a mutual agreement giving them a control before the closing date, but it is subject to approval. If the approval is substantive, can the date of acquisition precede the closing date? If it is substantive, and that's right, no, Competition Commission of India. Next, can I say if they mutually agree to give a control before the closing date, but it is subject to approval, which is not substantive in nature, so can the date of acquisition precede the closing date? And that's right, he said yes. Great. So I think you got the inputs in this particular case. The permutation combinations well understood. Good. Now let's make an interesting summary chart on the step number 2. You can see that, what we are technically doing is we are digging deep into each and every step. So that by the time we're done with the 6 steps, we are so strong that when we get a full-fledged question, we will be able to easily crack that question. Lovely. So let's, I think, make some good summary chart on the step number 2. So based on the learnings, I'm making a summary chart number 2. So this is a summary chart pertaining to the step number 2. So again, I would keep requesting you on that, friends. So please make your revisions. It's going to be very important to make cumulative revision because this is a technical standard. And once you keep making revisions, by the time you're done with the entire standard, once you look at the things in a complete go, this is going to be very easy and it becomes very scoring. Because if you got all the grip over the standard, it's going to be very scoring indeed. So let's put it like this. In terms of step number 2, that is date of acquisition. So I'll put it like this, that there are typically 3 cases. I would say there are typically 3 cases. One is the date of acquisition is equal to the closing date. The date of acquisition is before. The date of acquisition is before the closing date. And the next is a date of acquisition is after. The date of acquisition is after the closing date. Now, the learnings which we have developed in this particular case is that in this particular case, this is practically not applicable. So this goes away. And then we come to this particular case, we can say generally, this is always the case. Generally, this is always the case. So generally, you will see the date of acquisition and the closing date will be same. So what is the date of acquisition? When you get control. And what is the closing date? The closing date is when the PC is discharged. So if somebody says that what is the date of acquisition, I would say the day you get a control, and what is the closing date when the PC is discharged. Now, in this particular case, when you say that the date of acquisition is before the closing date, I'm looking at 2 combinations. So I'm looking at 2 combinations. One is control obtained later. Control obtained later plus agreement. Agreement gives control. Agreement gives control retrospectively. Agreement gives a control retrospectively. So can I consider the retrospective date? No. So in this particular case, we cannot consider retrospective date. We cannot consider the retrospective date. The second is that the date of control comes earlier. Control comes earlier by mutual agreement. Control comes by mutual agreement. When I say mutual agreement, of course, I'm saying it is written and it is non-binding. Sorry, it's written and binding. So I'm, of course, assuming that it is written and it is binding. So the control comes earlier, which is by a mutual agreement, which is written and is binding. So there are 2 cases in this case subject to approval. It is subject to approval, or we can say it is not subject to approval. It is not subject to approval. So can I say if it is not subject to approval, the date of acquisition is the earlier date. If it is not subject to approval, it is supposed to be the earlier date. And if it is subject to approval, let's put it like this. So we need to see that the approval is major or not. So we need to see in this case that the approval is substantive, that is major, or it is not substantive. So if you say it is substantive, then it cannot be the earlier date. It cannot be earlier. And if it is not substantive, It is supposed to be the earlier date in this case. This gives me all the permutation combinations for understanding. Wow. So more or less, I've tried to make a summary chart in terms of all the learnings, which is coming from the illustrations as well. So generally, your date of acquisition and closing date is same. And the date of acquisition is after closing date, practically not possible. So we just need to be clear when the acquisition date precedes the closing date. So when you say retrospectively, I get a control in spite of the fact that you're getting it later, you cannot consider the earlier date. And if you say that by an agreement it comes earlier, then I would say, okay, if it is subject to approval, you need to see the approval is substantive or not. And if it is not subject to approval, then we can always say the date of acquisition precedes the closing date in this case. Okay, so step one, I got your, comfort zone on a scale of 10. I think it's time to get some comfort zone on the step number 2 as well. Then we go to the step number 3. So let's, I think, ask your comfort zone scores on the step number 2, getting acquisition date. 10 out of 10, 9.9. That's wonderful indeed. Superb. 10 out of 10. Superb indeed. 10 out of 10. That's great. Okay, that's wonderful indeed. Okay, so now we're going to go to the step number 3. Now, step number 3 is going to be a little more complicated in nature. Sir, since the standard, the level is increasing. Last class also, it was complicated inputs. This class also, it's coming to, a lot of things to be kept in mind. Let's go ahead, friends. Because as we're now going to proceed, things will get a little complicated. But once you get a grip on these 6 steps, as I said, life is going to be very easy. So I'm now going to take you to the inputs in terms of the step number 3. There is a wonderful chart which is given in terms of the step number 3. I'll first take you to that chart. Wow. Now that is an interesting chart which you must have a look. It's a very good summary. It's a very good summary, and we're going to work upon this summary. A lot of places I can see in the study material, so much of good efforts have been done, commendable. I would say it's really commendable, the kind of hard work which has gone in terms of things, commendable efforts. Because a lot of summaries, a lot of conceptual clarity, it throws a lot of conceptual clarity on a lot of places. I just love, these kind of charts which are made, which is giving a lot of clarity of thoughts. Now, first, let me give you a thought process on the step number 3. Now, this is going to be a bit technical, so please hear me very carefully. Please hear me very carefully. I'm just going to take you to the step number 3 and give you a thought process. So we are on step number 3 now. And in terms of step number 3, we're looking at the list of net assets. We're looking at the list of the net assets because in the acquisition entry, you need what is the net assets to be captured. Now, first of all, let me tell you that step number 3 will trigger the impact of Ind AS 12. But we'll talk about that impact of Ind AS 12 very shortly later. Let's keep that aside. But we need to merge the concept of Ind AS 12 and Ind AS 103 as well. But before that, let's say this is A Limited. Let's say he is the legal as well as the accounting acquirer. So let's say he is the legal as well as the accounting acquirer. And let's say there is B Limited, who is, let's say, the accounting acquiree. Who is the accounting acquiree? Now let's first understand the thought process which you need to apply in terms of step number 3. So this is accounting acquiree and he is the accounting acquirer. Now let's visualize the balance sheet of B. Let's visualize that this is the balance sheet of B where we are given the assets and we are given the liabilities. And let's visualize that we are putting an acquisition entry. Let's visualize we're putting an acquisition accounting entry where I need to capture the net assets and record them on the debit side of this entry. Now, please hear this carefully. Don't worry, we'll pen down those thoughts, but I first want to give you a thought process. Now, all these assets and liabilities are captured at a book value in the balance sheet of B. But all these net assets are going to be captured at a fair value. They're supposed to be captured at a fair value. So the basic thumb rule which you need to keep in mind is assets and liabilities in the balance sheet of B will be captured in the acquisition entry at a fair value. The basic thumb rule is that you will capture these assets and liability in the acquisition entry at a fair value. So that is a thumb rule. But then there are a total of three exceptions. So what I'm saying, the basic thumb rule, the basic thumb rule is that in the books of A Limited, what we're going to do, we will capture the net assets at a fair value. That is the basic thumb rule. But then there are exceptions. There are certain exceptions. And we need to understand what are the exceptions. So I will now give you that there are a total of three exceptions. Please watch the thoughts very carefully, because your thought need to be very clear when you're making a list of net assets. So you know the thumb rule is all the assets and liabilities will be captured at a fair value. Now let's look at the exception. The asset and liability is in the balance sheet of the acquiree at a book value. The asset and liability is in the balance sheet of the acquiree at a book value, and it will be captured in the journal entry. At the book value itself. It will not be captured at a fair value. So I will capture the asset and liability which is in the balance sheet of the acquiree at a book value, and it will be taken in the entry at book value itself. This is called exception to the measurement principle, because your measurement is taking place at a fair value. So this exception is technically called an exception to the measurement principle. It's an exception to the measurement principle. Now you will say, so what exceptions will come here? What are those assets and liabilities which are in the balance sheet of B, but they will be taken as it is in the acquisition entry of A? Don't worry, but you just need to get the thoughts clear that this asset and liability which is in the balance sheet of acquiree appears in the entry as it is. It's called a measurement principle exception, because the measurement is supposed to be at a fair value, but you're measuring at a fair book value. So it's called a measurement principle exception. Next, the next inputs we're looking at is the asset and liability. The asset and liability is not appearing in the balance sheet. The asset and liability is not appearing in the balance sheet of the acquiree, but it is captured in the journal entry, and that is at the fair value. The asset and liability is not in the balance sheet of the acquiree, but it is captured in the acquisition entry at a fair value. So what is there will be taken at a book value as an exception, but generally at a fair value. But then the second exception is it's not even there. But I'm still going to record it in the journal entry and at a fair value. This is called recognition exception. That something which is not recognized is getting recognized. So this is what is technically called recognition exception. Because it is getting recognized, so it is called a recognition exception. This is measurement principle exception, and that is a recognition exception. So this is getting too technical now. Don't worry, I will connect the dots again and again so that everything gets inserted in the mind. Next. Now I'm looking at the third exception. The asset and liability is not in the balance sheet of the acquiree. Same case, the asset and liability is not in the balance sheet of the acquiree, and in this particular case, it still appears in the entry, and this appears in the entry not at fair value, but some other value, not at a fair value. So if it is not appearing at a fair value, measurement exception. And it is not in the books of the acquiree, recognition exception. So this is called recognition and measurement exception. This is both in the sense it is supposed to be a recognition and a measurement exception. It is called a recognition and a measurement exception both, because it is not in the balance sheet but getting recognized, and in this particular case it is getting recognized not at a fair value. So can you please again connect the dots in terms of things? Now, first of all, let me do one thing. Based on all these inputs, I'm going to make 4 statements. And once I've made all the 4 statements, and then we'll start working on what is each of the statement called. So let me make 4 statements. You just need to say, is that possible? Yes or no. So the questions will be the combination which I'm giving you is a possible combination, yes or no. So what are the examples of asset liability not appearing in the balance sheet? We will see that, no worry. All these combinations that we'll see, this chart which is there, this is going to give you all the exceptions of assets and liability which are there. Then we'll start working on each of these exceptions as well. And once we get the clarity, because I remember, there is a question in the study material in Ind AS 103, which is a beautiful question. And it is devoted only practically, the major concepts of that question is devoted to step 3. There are certain questions in the study material which is devoted to step number 4, that is the calculation of PC. Then there are certain questions devoted to step number 3. You get a complete insight in terms of applying that step 3 and 4. Because step number 4 and 3 is the most crucial part. Step number 5, ICAI, or step number 6, goodwill, is not a big deal. So that's not a very complicated one. But I think step 3 and 4 is the most crucial one. So list, we'll come to that. That's not an issue. But let's, I think, first make some quick statements to you. Can I say assets and liability in the acquiree's balance sheet as a thumb rule will appear at a fair value? Agreed. Assets and liability in the balance sheet of the acquiree is going to appear in the acquisition entry at a fair value. That is the thumb rule. Good. Can I say exception? They may appear at a book value itself. It is called what principle? M, R, M and R. M for measurement, R for recognition. So is it a exception relating to M, R, or both? That's right. It is an exception to M. So the asset liability is there. It is captured at fair value, common rule. It is there but captured at the book value. That is a measurement exception. That is one combination. It is there, taken at a fair value. It is there, taken at a book value. Next. It is not there. It is not there, but it is still taken in the acquisition entry at a fair value. Which exception, R or M? It is not there, but it is still taken at a fair value, and that's a recognition exception. And the next is, it is not there. It is not there, but it is taken at a other than a fair value. So it is not there, and it is taken at a value other than fair value. So it becomes what? Both recognition and measurement. Now we need to be clear in terms of which assets and liability are those exceptions. Let's come back on the agenda. So now let's have a look at this chart, because we're going to work upon these issues as well. So let me, I think, begin with the inputs now. It says exceptions to recognition and measurement principle. It's an exception to recognition and a measurement principle. Now it says, see what it says, asset or liability which otherwise would not have been recorded gets recorded. Not recorded gets recorded. Not in the balance sheet, but still gets recorded. Which exception? Not in the balance sheet, but it still gets recorded. Which exception? R. That's right. So this is called recognition exception. That means it is not in the balance sheet of the equity, but in the journal entry it will appear. So it says otherwise not recorded, but gets recorded. Wow. Now let me tell you something, friends. As an equity, he would apply the relevant standards. But as an acquirer, he will not apply the relevant standard, but he will apply the guidance in 103. For example, if there is an internally generated intangible asset, as an equity, you did not capture it in the balance sheet because of Ind AS 38. But as an acquirer, you apply 103 and not 38, and therefore you will capture those internally generated assets as acquired assets at a fair value. Did you get the answer, what you were asking? Great. So now if you look at this, there are a couple of exceptions, and the only exception given is contingent liability, which is recognized at a fair value. The contingent liabilities are appearing in the notes to accounts of the equity, but they will appear in the journal entry in the books of the acquirer if the fair value can be measured reliably. So the exception, this is the only exception given, though we will be talking about intangible assets also. But let's consider that intangible assets will get incorporated in the acquisition entry. Now let's come to the other one. The assets and liabilities are measured at a value other than fair value. They are measured at a value other than fair value. Which exception? R or M. So they are in the balance sheet of the equity. They will appear in the acquisition entry, but not at a fair value. So it becomes what? M. It can be both R, M, and M. So it's a measurement exception, or it's both measurement and recognition. Because if it is there and it gets captured at other than fair value, measurement. Not there, gets recorded at a value other than fair value, both recognition and measurement. Now, in terms of the list of the measurement exceptions, we are given the measurement exceptions out here. Share-based payments, NCA held for sale. Remember, in terms of NCA held for sale, Ind AS 105 tells you to capture at fair value less cost to sell. So that means this asset in the balance sheet of the equity would be appearing at a fair value less the cost to sell. So you would capture it in the entry at the same value. I'll not bring it to fair value. I'll let it be at the book value, which is the net fair value. So it says it is measured as per Ind AS 105 itself. The equity would have measured it at a fair value less cost to sell. You continue. And then it says something about reacquired rights. Now, it's difficult to explain you the concept of reacquired rights and the share-based payment awards. But I'll tell you something technical, friends, now. The share-based payments awards, I will take it in step number 4, not in step 3. The reacquired rights, I'll take it in step number 4, not in step 3. Not in step 3. So effectively, out of the 3 exceptions, we're going to tackle only one exception in terms of measurement, NCA held for sale. So there is one exception to recognition, contingent liability, one exception to measurement effectively, that is NCA held for sale. Share-based payments, we will take care in step 4. Reacquired rights, we'll take care in step 4. I'm just giving you a thought process. And then comes the input in terms of both recognition and exception. So there is exception number 1, income tax. Exception number 2, employee benefits. Exception number 3, indemnification assets. And exception number 4, leases. So there are 4 exceptions to recognition and measurement. One is which is called income tax. Reason, when Ind AS 103 will be applied, we will apply the deferred tax implications as well. You've done Ind AS 12, right? You've done Ind AS 12, correct? Yes, then I think let me take advantage of that. Now, let me, ask you a very basic question. Can I see in the books of the acquirer, the asset liability is captured at a fair value and that becomes the book value? But the tax base is going to be based on the original cost because income tax will not recognize the concept of a fair value. Will this lead to a difference between a carrying amount and a tax base and lead to deferred tax consequences? All these assets and liabilities are getting captured in the acquisition entry at a fair value. If all of them are getting captured at a fair value, can I say it lead to consequential deferred tax asset and liability, and that will get recognized and measured as per Ind AS 12. So this will get recognized as per Ind AS 12. That's deferred tax. The next one is employee benefits will be taken as per Ind AS 19. I will take them as per Ind AS 19. So maybe the acquiring company was not capturing the employee benefits, maybe because they did not have, employees on roll, they were contractual or whatever. So if employee benefits need to be accounted, they will be as per Ind AS 19. The relevant standards are applying. Indemnification assets will also be taken. What is indemnification? We'll see that later. What is indemnification? We'll see that later. And then there is lessees in which acquiry is a lessee. So there is something which is related to Ind AS 116. You've done Ind AS 116, then I can speak something at this stage itself. So yes, that's great. So let me take advantage of that as well. So it says leases in which the acquiry is a lessee. You need to recognize a ROU asset and a lease liability as per Ind AS 116. It says except if it is a short-term lease or it is a low-valued asset. So which means if you are supposed to be capturing the lease transactions, you know that in lease transactions, you need to capture the right of use asset and the lease liability in the acquisition entry by virtue of Ind AS 116. You will measure the lease liability at a present value of remaining lease payments and measure the asset also at the same amount itself. Sir. Now let me, consolidate all the points with a deferred tax put together. I now need to give you a complete thought process in terms of the step number 3 to get it very clear. So in terms of step number 3, we are now going to divide the exercise in 2 parts. Step number 3A and step number 3B. Let me document this part now to you. So I would say that if I am looking in terms of the step number 3, I'll divide my step number 3 in terms of 2 steps. I'll divide my inputs in terms of 2 steps, step number 3A and step number 3B. Now, this is an important thought process which I need to give you so that you get clarity of thoughts. So in terms of step number 3, where I said I want to make a list of net assets, your focus point in terms of step number 3A is the tax rate given? Your focus point would be to see that is the tax rate given in the question? Are you given a tax rate in the question? If you are given a tax rate, deferred tax consequences will be applied. So before you make a list, you will first apply Ind AS 12. So you will put across a question that is the tax rate given in the question. If the answer is a yes, we will apply Ind AS 12. And you will calculate for all those assets and liability whose carrying amount is now equal to fair value, compare them with the tax base. So what I'll do in this particular case, I will say for all those assets and liability for all those assets and liability whose carrying value is equal to the book fair value now, because you've captured them at the fair value. So the carrying amount is equal to fair value. Compare this with the tax base. And if you get any deferred tax asset liability, you need to capture that. So recognize DTA or DTL. You'll capture the deferred tax asset or the deferred tax liability as the case may be. And this will become a part of your list of net assets. In the acquisition entry, the DTA DTL is going to be captured in the acquisition entry itself. But if you say, no, there is no tax rate given in the question, then you can say no deferred tax asset or deferred tax liability. So indirectly, no Ind AS 12 to be applied. I hope I'm clear on my thoughts on step 3A. So you can say the attacking point in terms of step 3 will be 3A. You're going to see that is the tax rate given in the question or not. If the tax rate is not given, then there is no DTA DTL to be taken in the acquisition entry. But if the tax rate is given, you will first of all identify, list out all those assets liability whose carrying value is the fair value, compare it with the tax base, get the taxable deductible differences, get a DTA DTL exactly the way you did in terms of Ind AS 12. Next. When you come to the step number 3B, now we will make a list of net assets. Now we will make a list of net assets in this case. And when you make a list of net assets, so we will apply a thumb rule. We will apply a thumb rule, and the thumb rule is that all assets and liabilities are captured at fair value. So we'll apply the thumb rule. They're all captured at a fair value. So this is the basic thumb rule, that you will take all the assets and liabilities at a fair value itself. But then we've got exceptions. And then we've got exceptions. So now we'll make a list of the few exceptions which we are going to cover. So the exceptions which I gave you are 3 major exceptions. So one is what is called recognition exception. One is called measurement exception. And the other one is called recognition plus measurement exception. That means it's both. So you've got a recognition exception, a measurement exception, and recognition measurement both. What does this mean? Let's also understand what does this mean. When I say recognition measurement exception, let's also understand what does this exactly connote. So when you say it's a recognition exceptions, that means the assets and liabilities will be, in this particular case, the assets and liabilities which are not there will be captured at fair value. So this means the asset and liabilities are not there, but they will be captured at fair value. And the only item which is there is the contingent liability. So you need to remember the list, that this is the item contingent liability. So I think I'll just connect you back out here. You can see the contingent liability is the recognition, which means a very important observation. Acquiree applied Ind AS 37 to decide whether it is a case of provision or contingent liability. Acquirer will only apply 103, not 37. And he will say, okay, can I get the fair value? If I can get the fair value, please put it in the entry. So acquiree applied the principles of Ind AS 37 and decided that it's a contingent liability or provision. Acquirer will not apply 37. Acquirer will apply 103. What 103 says, can you get the fair value of this contingent liability? Yes, please put it in the entry. Done. Now, the measurement exception is the asset and liability is already there and it will appear. It is already there and it will appear, but it's not at a fair value, at other than fair value. It's other than fair value, so it is going to appear at other than fair value. Now, in this particular case, we have got 3 exceptions. One is NCA held for sale. This will be appearing as it is as per 105. Acquiree recorded at a net fair value. Acquirer also records it at the same value, net fair value. Then the other one is share-based payments. And the other one is what is called reacquired rights. What is called reacquired rights. But these two we will not consider here. So I'm just going to pen down this, that as far as these two is concerned, they can be taken in this step. They can be taken in this step, but we will not take them in the step. So I'm just putting that out here, that they will be, we will consider them. We will consider them in step number 4. So we will not consider them in step number 3, but we'll consider them in step 4. When I come to the concept of purchase consideration, I'll take care of this SBP. When I come to the concept of purchase considerations, I'll come to the concept of reacquired rights. So don't even apply your mind at this stage. What is this reacquired right? So you should be clear on the contingent liability and you should be clear on the NCA, which is held for sale. Now, coming on the recognition and the measurement exceptions both put together, in this case, we can say the asset and liability is not there, but it will appear and it's again other than fair value. It's again other than fair value. So in this case, the asset and liability is not in the balance sheet of acquiree and it's going to appear in the acquisition entry, but other than fair value, not there, getting recognized, recognition, but at a value other than fair value, measurement exception. And in this case, you saw that there were 4 items: income tax, employee benefits, indemnification, and leases. So we've got 4 items out here. So effectively, you can say 1 + 3 + 4, a total of 8 items you need to consider when you put the acquisition entry. So the first one is income tax. Which is this income tax? This DTA as well as DTL. And where you get this DTA, DTL? You've already organized this in step number 3A. You already organized this in step 3A. So this deferred tax asset liability, I've already worked out in step number 3A. So it'll be taken in this list itself. Then we will consider indemnification assets. What is indemnification assets? We'll see. We're yet to see what is the concept of indemnification. So we'll see that indemnification. Then there is leases, where we need to apply Ind AS 116. And I think the next item which is there is in terms of employee benefits. Correct. So this is employee benefits. So we can say that in terms of employee benefits, you will apply Ind AS 19. In leases, we will apply 116. So leases will be captured, you can say ROU asset and a lease liability, taking the present value of the remainder payments. Employee benefits totally on account of Ind AS 19. Indemnification assets will take later. So I've given you the entire thought process of how the step number 3 is going to be applied at a consolidation level. I know it's getting heavy and it's getting too complicated, but you need to be very crystal clear on the thoughts. So when you're going to proceed in step number 3, now step number 3A will get a basic flavor in terms of Ind AS 12. I will take, not today, but I'll take one example in the next session with you, where we'll get a basic flavor of how the step number 3A is applied. Reminding you some basic inputs on Ind AS 12, identifying its taxable deductible differences, and how do you get the DTA, DTL, which is to be incorporated in step 3B. And we need to work on these so-called 8 exceptions, but I've already removed 2, so I can say 6 exceptions. We'll work upon contingent liability. NCA held for sale is already very clear. Leases and employee benefits is clear. We're going to work on indemnification. So effectively, I'll work on contingent liability. I'll work on indemnification assets, and I'm going to work upon, you can say, the deferred tax. So we're going to work upon these 3 main exceptions, and that will take care of our step number 3. I hope the thought processes are clear. Please do revise this part, you know what I've done, because we're going to work upon this step number 3, the most crucial step in terms of acquisition accounting. Right, friends, I think that seems to be quite good for the day. You must be feeling a bit heavy as well. If yes, very good. If no, very bad. Perfect. That's wonderful indeed. If you're feeling perfect, that's superb indeed. Right, Fan, any questions on your side? And please, as I again insist, please do revise this. As we meet in the next session, I am going to make some quick summary maps on the step 1, 2, and 3, and then we'll start proceeding with these particular exceptions with you.
Sir, in recognition principle, current asset is also considered or not?
Current assets, no,
Okay,
in a
sorry,
sense,
contingent assets. Sorry,
okay.
contingent assets.
Contingent asset is basically, you can say, the indemnification assets in a way, because indemnification is the compensation against that contingent liability. But if you're talking of contingent assets, they're always in the notes to accounts in the books of inquiry. So they will never get captured in the acquisition entry, even for the acquirer.
Okay, sir, thank you.
You're most welcome. Right, friends. So I think that seems to be good for the day. So time to say goodbye to you. So see you in the next class. Thank you. Bye bye. Enjoy your day. Take care. Thank you. Hanji, thank you. Same to you.